Finally, we build the cornerstone of financial security, the emergency fund. This dedicated savings account covers unexpected expenses like car repairs or medical bills. Without this buffer, any financial shock can derail your goals and force you into debt. Aim to initially save $500 to $1,000 as a starter fund. Then gradually build it to cover 3 to 6 months' worth of essential living expenses. Treat this fund as a non-negotiable monthly expense, even starting with a small automatic transfer. Having this foundation provides peace of mind. It creates the stability needed to pursue your other financial goals without fear of life's inevitable surprises. Welcome to the foundation of your financial journey. Personal finance is simply how you earn, spend, save, and invest your money. Before diving into habits, we must establish a clear destination. This begins with setting smart financial goals, specific, measurable, achievable, relevant, and time-bound. For example, save $1,000 for an emergency fund within 10 months. Start by identifying your short-term, medium-term, and long-term aspirations. This process turns abstract dreams into actionable targets. It gives your daily spending and saving decisions a powerful sense of purpose and direction. With your goals in place, the next step is understanding your current financial landscape. You cannot build a stable foundation without knowing your starting point. This requires a clear, honest look at your cash flow. For 1 month, track every single dollar that comes in and goes out. Categorize your spending into essentials, non-essentials, and obligations. This exercise isn't about judgment, it's about awareness. You'll likely discover surprising spending patterns. This snapshot reveals the gap between your current habits and your stated goals, highlighting areas for change. First, start by tracking every dollar for 1 full month. This is your financial snapshot. Use a simple spreadsheet, notebook, or a budgeting app to categorize every expense and list all income. The goal isn't to judge your spending but to see the honest, complete picture. You'll likely discover patterns and money leaks, like unused subscriptions. This foundational step removes the guesswork. It provides the raw data you need to build a realistic budget for your actual life. Next, create a zero-based budget before the next month begins. This means giving every dollar of your income a specific job so your income minus expenses equals 0. Start with essential fixed costs, then variable necessities, followed by financial goals. Finally, assign money for discretionary spending. Prioritize needs over wants and savings over spontaneous spending. Use a digital envelope system by allocating funds to categories in your bank app. Commit to not spending more than what's allocated in each category. This proactive plan puts you in control. Finally, implement a simple system to monitor your cash flow weekly. Set a 15-minute recurring appointment every Sunday to review your accounts. Compare actual spending against your budgeted amounts. Did you overspend on dining out? Adjust as needed. You can move money between categories. This regular check-in prevents small oversights from becoming major monthly deficits. Consistent, brief reviews turn budgeting from a restrictive chore into an empowering tool. It actively directs your money toward your personal goals and financial security. A checking account is your financial hub for daily transactions. It's where your paycheck is deposited, and from which you pay bills and make debit card purchases. The key is avoiding overdrafts, which result in costly fees. Set up low balance alerts and consider linking a savings account for overdraft protection. Always monitor your balance and pending transactions regularly. A savings account is for storing money you don't need immediately, helping you build a financial cushion. Unlike checking accounts, savings accounts earn interest, allowing your money to grow modestly over time. Federal rules limit certain withdrawals to 6 per month. To build savings effectively, automate the process. Set up a transfer from checking to savings each payday, even a small amount. This pay-yourself-first approach makes saving effortless. It prioritizes your financial security before you have a chance to spend the money elsewhere. Modern banking services are crucial for smart money management. Online banking allows remote check deposits, instant transfers, and electronic bill pay, saving time and postage. Take advantage of tools like budgeting apps offered by many banks. For security, always enable two-factor authentication and be wary of phishing scams. Your bank will never ask for your password. Your credit score is a 3-digit number lenders use to gauge your risk. Think of it as a financial report card. A higher score means better interest rates on loans and credit cards. It's calculated from your credit report. Key factors include payment history, amounts owed, and length of credit history. You can check your score for free through many bank apps. Your credit report is the detailed ledger behind your score. It lists your credit accounts, payment history, and loan balances. Review your reports regularly for errors or signs of identity theft. By federal law, you get one free report from each bureau every year at annualcreditreport.com. If you find an error, dispute it directly with the bureau. They are legally required to investigate. Responsible credit use means leveraging credit to build a strong profile without overextending. Pay every bill on time, set up autopay. Keep your credit utilization ratio below 30%. Only apply for new credit when necessary. Good credit affects loan rates, renting, and even jobs. Start with one card for small purchases paid in full each month to build history. First, take a full inventory of your debt. Gather statements for every single debt, credit cards, student loans, car loans. List the creditor, balance, minimum payment, and interest rate. Seeing the complete picture is empowering. You cannot manage what you don't measure. This list becomes your strategic map for choosing a payoff method. After choosing your payoff strategy, scrutinize your budget for extra cash. Analyze monthly spending to identify non-essential categories where you can cut back, like dining out or subscriptions. Redirect every dollar saved directly to your target debt. Simultaneously, explore ways to increase your income through a side hustle or selling items. This cut and boost approach accelerates your timeline. Finally, as you work to eliminate debt, avoid accumulating new debt. Change the habits that led to it. If credit cards are the issue, consider using cash or a debit card instead. Build a small emergency fund to cover unexpected expenses so you don't rely on credit. Celebrate small milestones to stay motivated. The goal is to build habits that keep you debt-free. An emergency fund is your financial safety net. For most in the US, the initial goal should be to save $1,000 as a starter fund for minor repairs or copays. The ultimate target is 3 to 6 months worth of essential living expenses. This protects against major events like job loss. Open a separate, accessible savings account and automate a transfer. Treat this contribution as a non-negotiable bill. The peace of mind this fund provides is the cornerstone of any solid financial plan. Alongside your emergency fund, actively save for short-term goals. These are planned expenses within 1 to 3 years, like a vacation or a new laptop. Break these goals into manageable monthly savings targets. Create a separate savings bucket for each goal. This method, called sinking funds, prevents dipping into your emergency fund. It helps you avoid using credit cards for predictable expenses, keeping you on a cash-based, intentional spending path. To fund both your emergency reserve and short-term goals, you must pay yourself first. Prioritize savings as soon as you receive income, not from what's left over. The most effective tool is automation. Set up direct deposits from your paycheck into designated savings accounts. Regularly review your budget to find areas to cut back and redirect money. Consistency is far more important than the amount. Saving a small amount weekly builds discipline and compounds into significant sums over time. Investing begins with understanding the core building blocks. Stocks represent ownership shares in a company, offering high growth potential but with higher risk and volatility. Bonds are loans you make to a corporation or government. They provide steady income and are generally lower risk, but with lower growth potential. A balanced mix aligns with your risk tolerance. To avoid picking individual stocks, many investors use mutual funds and exchange-traded funds, ETFs. These are pooled vehicles holding a basket of many securities. Their primary advantage is instant diversification, which significantly reduces your risk. They are the most practical tools for building a solid investment foundation. A 401k is a powerful retirement tool, offering tax advantages and often an employer match. Contributions are made before taxes, reducing your current taxable income. Always contribute enough to get your employer's full matching contribution. This is free money. Be aware of annual contribution limits and penalties for early withdrawal before age 59 and a half. Individual retirement arrangements, or IRAs, offer another avenue for tax-advantaged savings. The two main types are the traditional IRA and the Roth IRA. With a traditional IRA, contributions may be tax-deductible now. Roth IRA contributions are made after tax, but qualified withdrawals in retirement are tax-free. IRAs have wider investment choices but lower limits. For long-term goals, maximize contributions to tax-advantaged accounts. Traditional 401ks and IRAs reduce taxable income now, with tax-deferred growth. You pay tax upon withdrawal in retirement. Roth versions are funded with after-tax money. Your investments grow tax-free, and qualified withdrawals are also tax-free. Maximizing these accounts should be a top financial priority. Social Security provides a foundation of retirement income based on your lifetime earnings. You can start benefits as early as 62, but payments are reduced. To receive your full amount, wait until your full retirement age, between 66 to 67. Delaying past that, up to age 70, increases your monthly payment for life. It's meant to supplement your personal savings. Health insurance is a critical component of your financial safety net. Most get coverage through an employer or the health insurance marketplace during open enrollment. Key terms include the premium, deductible, copays, and coinsurance. Always check if your doctors are in network. Adequate coverage protects you from catastrophic medical debt. For auto insurance, understand your coverage levels. Liability pays for damage you cause to others. State minimums are often too low. Increase these limits for better protection. Collision covers your car from accidents. Comprehensive covers non-collision events. To save, ask about discounts for safe driving or bundling policies. Shop around every few years. Homeowners or renters insurance protects your dwelling and belongings. For homeowners, insured dwelling coverage is enough to rebuild your home. Liability protection is crucial for injuries on your property. Renters insurance is affordable and covers your personal property and liability. For both, a higher deductible lowers your premium. Life insurance, like term life, provides for dependents if you pass away. When it comes to long-term financial health, understanding taxes is non-negotiable. Proactive planning minimizes your lifetime tax burden through strategic use of tax-advantaged accounts. It also involves understanding capital gains taxes and your retirement income tax. Adjust your W-4 withholdings if you get large refunds or owe money, aiming to break even. Estate planning dictates what happens to your assets and dependents. At a minimum, create a will to specify asset distribution and name guardians for minor children. Establish durable powers of attorney for finances and healthcare. Regularly update beneficiaries on retirement accounts and life insurance policies, as these override a will. Putting it all together integrates daily habits with long-term pillars. Your budget should allocate funds for retirement contributions and annual expenses like taxes. Use automation to fund investment accounts right after payday. Schedule an annual financial review to reassess your budget, rebalance investments, and update estate documents. This holistic approach ensures your daily financial discipline directly fuels your long-term security and legacy.